Common stock. Common stock is the type most people think about when they hear the word stock. It represents ownership in a company, which means shareholders technically own a small piece of the business. If the company grows, the value of the stock can rise over time. Many common stocks also give investors voting rights during company decisions. Companies like Apple, Microsoft, and Coca-Cola all issue common stock. These shares are popular because they offer long-term growth, although prices can move up and down very quickly depending on the market. Preferred stock. Preferred stock works differently from common stock. Investors who own preferred shares usually receive fixed dividend payments before common shareholders get anything. In many ways, it sits somewhere between a stock and a bond. Preferred shareholders normally do not have voting rights, but they are given higher priority if a company runs into financial trouble. Because of the steady income they provide, preferred stocks are often used by investors who want more stability instead of aggressive growth. Growth stock. Growth stocks belong to companies expected to expand much faster than average businesses. These companies often reinvest their profits back into development rather than paying dividends. Technology companies are common examples because they focus heavily on innovation and future expansion. Investors buy growth stocks, hoping the company becomes much larger over time. The potential rewards can be very high, but growth stocks are also known for sharp price swings during uncertain markets. Value stock. Value stocks are shares that many investors believe are trading below their real worth. Sometimes a company may be profitable and stable, but its stock price stays low because of market fear or temporary problems. Investors search for these opportunities, hoping the market eventually corrects itself. Famous investors like Warren Buffett became well known for focusing on value investing. These stocks usually attract people looking for long-term opportunities instead of quick gains. Dividend stock. Dividend stocks are companies that regularly share part of their profits with shareholders. Investors receive payments called dividends, often every quarter. Large and mature companies commonly issue dividend stocks because their businesses are already stable and profitable. Utility companies, banks, and consumer brands often fall into this category. Many investors like dividend stocks because they can provide passive income while still allowing the stock price to grow over time. Blue chip stock. Blue chip stocks are shares of large, trusted, and financially strong companies. These businesses usually have long histories, recognizable brands, and stable earnings. During economic uncertainty, investors often move toward blue chip stocks because they are seen as safer compared to smaller companies. While they may not grow as explosively as newer businesses, they are often considered reliable investments for long-term portfolios. Penny stock. Penny stocks are very low-priced shares, usually belonging to small companies with limited histories. They are often traded outside major stock exchanges and can be extremely risky. Some penny stocks attract attention because their prices can suddenly jump in a short time. However, the same volatility can also lead to huge losses. Many investors avoid penny stocks because they are more vulnerable to scams, manipulation, and sudden company failures. Income stock. Income stocks focus mainly on generating regular earnings for investors. They are similar to dividend stocks, but the main attraction is dependable cash flow instead of rapid growth. Companies in industries like utilities, telecommunications, and energy often fall into this category. Retirees and conservative investors commonly choose income stocks because they prioritize stability and predictable returns. Cyclical stock. Cyclical stocks are heavily connected to the economy. Their performance usually rises during strong economic periods and weakens during recessions. Industries like travel, automotive, construction, and luxury goods are considered cyclical because people spend more money on them when the economy is healthy. Investors pay close attention to economic trends when buying these stocks, since timing can strongly affect returns. Defensive stock. Defensive stocks are companies that continue performing relatively steadily even during economic downturns. Businesses that sell essential products, such as food, medicine, and household goods, often belong to this category. People still buy toothpaste, electricity, and groceries no matter what happens in the economy. Because of that, defensive stocks are often seen as safer during market uncertainty. Large cap stock. Large cap stocks are companies with very high market values, usually worth billions of dollars. These businesses are often global corporations with established operations and strong financial records. Investors generally view large cap stocks as more stable compared to smaller companies. Although their growth may be slower, they are commonly used as the foundation of long-term investment portfolios. Mid-cap stocks. Mid-cap stocks sit between large companies and small companies. These businesses are usually still growing, but already have proven operations and market presence. Investors often see mid-cap stocks as a balance between growth and stability. They may offer stronger growth potential than large-cap companies while carrying less risk than smaller firms. Small-cap stock. Small-cap stocks belong to smaller companies that are still developing. These businesses may operate in niche markets or emerging industries. Because they are smaller, they often have more room for rapid growth. At the same time, they can be more vulnerable to economic problems, competition, and limited resources. Investors interested in higher growth opportunities often explore small-cap stocks despite the added risk. IPO stock. IPO stocks are shares that become available when a company first enters the public stock market through an initial public offering. Before the IPO, ownership is usually limited to founders, employees, and private investors. Once the company goes public, regular investors can buy shares for the first time. IPO stocks often generate excitement because some companies experience huge price increases early on. However, newly public companies can also face unpredictable market reactions. ESG stock. ESG stocks come from companies that focus on environmental, social, and governance standards. Investors who choose ESG stocks often care not only about profits, but also about how businesses treat workers, manage pollution, and handle corporate responsibility. Over recent years, ESG investing has become much more popular as more investors look for companies that align with their values alongside financial performance. International stock. International stocks are shares of companies located outside an investor's home country. Buying international stocks allows investors to gain exposure to different economies, industries, and currencies. Some investors use them to diversify their portfolios and reduce dependence on a single market. However, international investing can also involve additional risks, such as political instability, currency changes, and foreign regulations. Like and subscribe for more simple finance explainers. Turn on the bell so you never miss a new video. See you next time.